Okay, very good morning, Wednesday the 14th of June. Let's get the briefing for this morning underway. And just taking a recap on the close last night. For those who've caught up with the press already, the closing levels of the US indices last night, the S&P up about 0.5%, Dow up 0.4%, enough to hit once again record high territory in those two indices. The Nasdaq actually outperformed those on a percentage basis, pretty much 2 to 1. It was up just shy of 0.8%. The outperformance probably explained by a reversal of the pretty persistent underperformance that we had after the tech sector was under some pressure out of what's said to be a bit of a rotational play on the breakdown of the sectors following the outperformance of some of the big tech names and sentiment stocks that we'd had from the beginning of the year. So a positive lead from the US. Not a great deal going on in Asia, in all honesty. We'll talk about some Chinese data which did come out, which is important, but I'd say from a market focus point of view, people aren't really tracking Chinese data at this point with great interest. The story very much, certainly today, will be focused on the US, given the FOMC rate decision we'll get this evening. But looking at how this morning is set up, obviously the positive sentiment has kind of followed through, if you like, into the European Open. A couple of news stories I'll run through shortly, but you can see here the DAX up into positive territory, Euro stocks following suit. In terms of the FX markets, the dollar just slightly softer, down about 1/10. Cable continuing to come back from obviously the weakness that it saw in the hung parliament situation, but we'll have a look at some of the charts and setups for the day ahead after I've gone through some of the major news items. So fairly flat in treasuries. That's pretty much as to be expected. I'd imagine that asset class to remain particularly quiet until we hear from the Fed later on today. And in crude oil, you can see there's been a bit of a dip overnight, a reversal of the gain seen late yesterday afternoon, of course coming after the APIs we had, and then since then in the Asia Pac session we've pretty much traded tightly around pivot on the daily levels, which is also the $46 handle. But let's have a quick run through the news then, and then we'll come back to the charts and we'll discuss potentially a few things to be keeping an eye on. And as we've just said, cable trading positive territory. We are getting back in toward territory of the 128 handle. Some of the headlines that have come out this morning are focused on talks where Theresa May was attending the friendly between France and England at the Stade de France, and Macron, when questioned, has essentially left the door open to the UK staying in the EU. Pretty similar rhetoric to what we've heard from Merkel and the German Finance Minister Schäuble, who tends to be a fairly outspoken and opinionated fellow. He's also said that if the UK wanted to call off Brexit, then the EU would welcome them with open arms. So quite interesting to see this European angle, you know, instead of the Brexit negotiators like Barnier, for example, or EU's Tusk. They've been pretty vocal and fairly aggressive in kind of pinning their post in to get negotiations underway. But most of the major politicians, if you like, from various countries seem to be quite willing to, you know, leave the door open if the UK decides to change his mind, which I think at this point certainly cannot be ruled out, albeit a very low probability. But if you think about it, the fact of a hung parliament was a very low probability. So who's to say we don't go down that avenue in the long run? So she met with Macron. Nothing really too much coming out of that meeting other than the statements that he made in regards to the future of the UK. Elsewhere, you've had David Cameron calling on Theresa May to embrace a softer Brexit. So if you like, the chorus of people pushing the dropping of that's kind of slogan that Theresa May had about no deal is better than a bad deal. Jeremy Corbyn, for one, has said if you drop that, then we can start talking about Labour helping in these Brexit negotiations. But until that happens, and that's not going to be the case, David Cameron pursuing the same kind of avenue of trying to back support of a softer Brexit, I would say that's fairly unsurprising. He's a politician now that's kind of out of the main fray, so he can be a little bit more outspoken in that regard. One thing I did see last night, YouGov, who would be the best Prime Minister? I'm going to have to make safe happy for this Wednesday morning. Jeremy Corbyn is now neck and neck with Theresa May as which of the following do you think would make the best Prime Minister? So certainly Jeremy Corbyn, who was probably 2 months ago seen as the worst Labour leader in the history of its party, now is neck and neck with Theresa May. Whether or not this is a performance of Corbyn having really improved his overall performance on nearly every metric since the campaign got underway for the election, and also probably a combination of Theresa May doing a particularly bad job in the run-up to the snap election. Probably the dual force is what's seen the gap now level out between the two party leaders. But going back to cable, just having a look at where we trade at the moment. Obviously here we identify the gap lower that we had, and the futures market reopened. Obviously the spot price shot lower on the exit poll, and so looking at these levels, we're at R1 at the moment. We've had a little bit of a move as Europe has come in. Again, a couple of these press stories kind of erring on the soft Brexit side, which will probably be of light relief to the sterling currency if that kind of rhetoric continues. But on the upside, should we get above this R1 and 128 handle, then obviously R2 pretty much lines up exactly with the high print that we had with the volatility that came in the futures market the night of the results coming in on the election. So pretty strong level there on the upside that I'd definitely be monitoring if the cable price action continues that way. Just looking beyond there, obviously acted as well as some support back on the beginning of the month on the 1st of June. So that's really the upside target. A break above there, then obviously we'll probably start pushing higher back up towards looking to 129 and above, but this would all be contingent, of course, on navigating through some of the Brexit talks and the formation of the government. I would say that the market, again, any fears that there were that a hung parliament would have resulted in 125 or below certainly have not materialised at this point. I'd say, if anything, the price reflecting still relative calm. We're still looking really for the deal between the Conservatives and the DUP to be finalised, but that looks to just be a matter of dotting the I's and crossing the T's in some respect. And it's that, I guess, assurance that that there is some political certainty, in addition to with some of the soft Brexit conversations that seemingly are going on, that's probably led to a fairly contained fallout, if you could call it that, than what we've had for the pound in reaction to the hung parliament situation. Yesterday, obviously, you had inflation numbers. Inflation now the highest since June of 2013. That's a bit of a double-edged sword. Yes, prices are higher. Typically, that would mean that the pound would strengthen. But obviously, the thing to monitor there is all to do with how does this continue to impact the UK consumer, their confidence and their ability to spend, with real wage growth in negative territory at the moment. So something to just keep in mind, which will probably contain the upside, would make me feel, at this point at least, with the exception of anything new, that level on the upside at R2 should be pretty strong in today's session. Quick look elsewhere. Let's have a look at oil. you can see we've had some pretty topsy-turvy price action over the last day or so. One thing is we moved higher pretty much around European cash equity close. There wasn't actually anything fundamental to support that rise. But then at 9:30, of course, the release of the API crude oil inventory saw prices pretty much pair that entire move higher. A fairly sizable move actually as far as API reaction goes, a move of just over 50 cents. If I look at that on a minute, it'll probably make a little bit more sense. I know someone asked me yesterday about trading the APIs, and my kind of advice was, well, it's a tricky one because you don't actually have transparency, because the number is released privately to those that subscribe directly and pay money to have access to the API. And so what you can see here is kind of tells that story where you've got an immediate move where those who have access to that report react. You then have this kind of hesitation as the rest of the market is unsure of what the number is, and then probably at that point it starts to get distributed on media outlets and things like Twitter. Then you get the secondary move as other participants react. Hence the reason why you get this kind of gradual move rather than an initial one spike lower like you would typically with today's Department of Energy crude oil inventory report, which there is a lot more clean cut with the first reaction. What trading that then is difficult, because you would see the market move. The market is telling you that this is a bearish report because the prices move lower, but you're having to go on really intuition, maybe monitoring the momentum on the ladder, the orders in the market, but you are of course going into territory that is extremely high risk because you don't know the number until you get clarity thereafter. But a quick look at those numbers so you're aware. We had a crude build of 2.75 million. That was a pretty much 5 million swing or so from what was expected, because we were looking for a draw of about 2.5 million. So a surprise build in the headline figure. Cushing a draw of 833,000. Gasoline a build of 1.794 million. Again, that's quite a bit away from consensus, which was for a draw of just shy of 1.2 million. And distillates was a drawdown of 1.451 million. So a bearish report, and that kind of sets the scene then for the crude numbers that are coming up later this afternoon. As ever, you'd probably be looking for some of the broader ranges to play out given the volatility that generally gets seen on the release of that data. 46.69, quite interesting, just given that was the high back at the beginning of the week on Monday. That also close proximity to the low print that was seen back at the beginning of the month on the 2nd. So above R1, firstly, probably be keeping an eye on that level. And then downside, certainly there's enough to volatility expected around the data. Should it be bearish, or more so than what we had last night, a retest of yesterday's low, and also S1 beyond there, then obviously looking at the recent move lower, which is defined by 45.20. Okay, looking at some other stories that we've had. You've got German inflation data this morning. These were final figures, so hence the reason the market hasn't really paid too much note of the reading. Confirmed at 1.4% in May, driven lower by smaller energy price rises and a significant fall in the cost of vegetables. You can see here, this is one of the things that has meant that the ECB could sound a little bit more dovish tilt to the press conference from Draghi last week, especially talking about QE and the ability to keep that going, and how positive as a program it has been for the European economy, because inflation at this point has started to tail off somewhat. So any fear that this excessive amount of money supply going into the market was going to stoke inflation has kind of dissipated. And hence the ECB can kind of remain a little bit more gradual in their approach rather than being forced by heightened inflation. Looking at the euro, not really too much to speak of here of interest. You can see that I think this was a level that Sam was looking at yesterday, a kind of various support point throughout the beginning of the month on a number of occasions. So on the downside, maybe just looking at that 112.10, but then below here, probably the low from very early yesterday morning down at 111.88. Should we get down to test around that S1, would be another level to also just keep an eye on there in the euro currency. In the DAX, obviously positive this morning, taking a bit of a lead, carrying the baton from the record high close in the S&P and the Dow yesterday. Not a lot in individual DAX news on a company perspective, but looking where we trade at the moment, you've got the high from the 9th, so this is Friday session. You can see we've kind of just got up to those key levels there, that kind of cluster of resistance kind of zone is where we've just found a bit of resistance here, which makes sense. The lack of news kind of drifted high on a sentiment more than anything, and thus run to a bit of resistance around these levels. So be looking at those to start with. If we go obviously beyond there, then if we just broaden out the chart slightly, we're not too far from record territory, don't forget. Above here, where you have the highs that then were marking the beginning of May and mid-May, then beyond there the record all-time highs sitting at 12,879.5. I'd say probably that level, the latter, bit of a push on the intraday, but certainly that R1 level could be interesting as well on the upside if we continue this trend of the morning. Just looking at equities, obviously just bringing the S&P into shot as well. You know, after the brief kind of wobble that we had on Friday when the tech sector really got burnt very quickly, we've gradually clawed that back. I mean, there's not really been a great deal of news out there. Certainly the Trump situation seems to have died down a lot in recent times. But I guess looking where we are at the moment, I'd be keeping an eye on where we were up towards the close of last night in the futures, 24.39 1/4. And then beyond there, obviously R1 is matching up with that all-time kind of high level that was printed on Friday afternoon before that tech sector got hit. So R1's pretty strong on the upside, but first of all we'd probably encounter, I'd imagine, some resistance at that high print from yesterday. I guess if you're looking at it today, given the gravity of the situation, the Fed carries importance. Although we're kind of roughly know what we're expecting, there's obviously a big tail risk that something unexpected could occur in terms of their language more than their decision on the interest rate. And so I'd probably be looking at this ranged potentially to hold between yesterday's high and pivot on the downside, all the way in the run up to the actual announcement when we get 7, and then the conference obviously at 7:30 as well. I guess that's one of the main points of today's session is I wouldn't expect too much to occur ahead of that. We do have some tier 1 economic data coming out this afternoon in the form of US CPI and retail sales, both of which are important, but potentially it might cause some very short-term volatility, but potentially a lack of persistent price direction, if you like, because people won't want to stay in trades for too long ahead of the Fed. Okay, quickly then, wrapping up the other headlines that have come out. So this is the Chinese data. So we're looking at Chinese retail sales, industrial output growth, static as investment softens. I wouldn't really read too much into this. As I say, the market is not really focused on China at this point. You can also see as well on the right hand side, the IMF have raised their Chinese 2017 GDP forecast from 6.6 to 6.7%. If anything, I guess a degree of stabilization to some respect. The fact that these data points, albeit investment is dropping, certainly something to monitor, but the other data metrics kind of holding steady. Looking at the calendar then for today's session. This morning we turn our focus in the UK to the jobs situation. The actual claimant count change and unemployment rate is not the focal point of the release. The unemployment situation has been fairly robust in the UK for some time. What is important though, certainly, is this second portion of data, if you like, which is the average earnings and average earnings ex bonus. This, as I just mentioned, the disparity between people's pay and the price pressures that they are under, rising inflation and with savings rates at record low in the UK at the moment. It is important that this number starts to track higher, or at least maintain its current rates in the wake of inflation rising. Anything weak could spell some downside pressure, certainly to reverse some of the morning's gains that we've seen in cable so far. We'll look at that shortly in more detail because it's coming out in about 40 minutes time. Elsewhere, you've got Eurozone industrial production, employment change. I would say I wouldn't be expecting a great deal of that in terms of price action in the European assets, but I would be keeping a half an ear on it. Then for oil traders, what could be interesting, you've got the IEA oil market report. Two main metrics there. You're monitoring what is the situation on the global demand side, and then how oversupplied do the IEA see the market at present. Quite a lot of articles that you guys have been sharing in the chat this morning talking about offshore tankers which were due for delivery with then cancellation of orders, and they're basically sitting offshore with no buyers because of the overflux of inventory that's out there globally at the moment. There's not enough demand to even eat into all of the supply that's out there. This then takes us into the US afternoon, and as I said, 1:30 is going to be very important, so you need to be plugged in and watching the markets at 1:30. CPI is probably the more important of the two if I was going to give it a hierarchy kind of factor, and this because the rate of inflation is a key component as to what the Fed might communicate later on this evening. Retail sales also is a tier 1 release. There's a couple of things that I've seen out of Deutsche Bank that might put the data in a bit of context. They said headline retail sales series should slow due to another disappointing month for unit motor vehicle sales. However, ex-automobiles should fare a bit better. With respect to the CPI, they expect energy prices will drag on the headline, likely resulting in a flat month-over-month reading. However, the core CPI series will receive significant attention given that the last couple of prints have been surprisingly soft. So this is when this CPI in particular is when we get into this situation. This is federal funds futures and what's being priced for tonight's FOMC decision, and you can see the market is positioned 99.6% certain that the Fed will hike interest rates 25 basis points. So it's completely priced in, almost. Now, there's never, that I can recall, statistically ever been priced into this value and the Fed has not delivered. If you think about it from a Fed communication point of view, if they were not going to hike rates, well, they've done an incredibly bad job in communicating to the market that that might be the case. The fact that they've been pretty vocal about the June hike to continue on their process of delivering 3 for this year, so March, June, and most likely September, then the rate hike is a complete done deal. When it's this priced in, this is not what traders will be focusing on. What traders will be focusing on then are the other facets as to what might materialize from their conversations today. And so these are the summary of economic projections, or i.e. the dot plots, which give you the trajectory of rate hikes in 2018, 2019 in the long run, and then also Janet Yellen will hold a press conference. What we've got here are a couple of things. As this summary from RAND that I sent out to you guys this morning, the rate hike has been heavily discounted market reaction isn't likely to take cues from the rate hike. Instead, we're looking at the projections for the rate path, and this is the key part, perhaps its balance sheet reduction pace. Also as well, I guess in the language, you're looking for, is there any explicit hint as towards the timing of the next hike that is currently expected from the Fed's forecasts. If I scroll down, there's a good kind of summary from analysts at Bank of America, Merrill Lynch. They believe the Fed will attempt to deliver what we call a dovish hike. That's what we've been talking about throughout the week. If you think about it, they're committed now to hiking rates. However, given the inflation aspect that we've just said, core inflation has been fairly benign, there's no need for them to be rushing and committing to further rate hikes or reduction of the balance sheet at this point in time. That means then that the communication is likely to be a hike, which is hawkish in a sense, but then dovish in terms of the following commentary. By dovish, you're probably looking at Janet Yellen to be just repetitive of the current stance of the Fed, continuing to be gradual and cautious going forward, continuing to monitor the situation with a particular focus on the likes of inflation environment in the US. What Bank of America go on to add is that the 25 basis point rate rise will be accompanied by unchanged dot plots. That's also what I think will occur today. But the statement will continue to reiterate weakness in inflation is transitory. This would go hand in hand with a downward revision to the core PCE inflation this year, but maintaining a 2% forecast for next year. We also think the unemployment rate will be revised lower. So a couple of things there to think about. We'll go into a much more thorough preview as we get closer towards the time of the Fed. These previews, though, I did send them out with one from Danske Bank as well to your inbox. So that's pretty much your briefing, getting you up to speed. So not a great deal of new news. I would say market likely to be a little bit of wait and see mode for this evening. Just to remind you, we will be open. I'll be here until about 8 o'clock this evening to cover the whole event in full. So the rate decision at 7 with the projections, and then Janet Yellen will start speaking at 7:30, usually about 20 minutes for a statement, which we will be looking for any language changes from the prior one that we had, and then the Q&A session with the first questions being the most important from a market potential moving point of view. Okay guys, going to wrap it up there. So 9 o'clock, UK data, particular focus on the wage numbers, keep an eye on that. Otherwise, have yourself a good session. Any questions, feel free to fire them in the chat room. Thank you very much.